The world's primary silver exchange is approaching a critical threshold. 400 million ounces of contractual obligations, less than 100 million ounces of deliverable metal. March delivery contracts are stacking up, and the vaults are running thin. This isn't speculation. This is inventory data from the exchange itself. Industrial manufacturers need silver for solar panels, electronics, medical equipment. Investors hold contracts promising physical delivery. But here's what almost nobody is discussing. What happens when the math simply doesn't work anymore? What happens when one of the world's most trusted commodity exchanges cannot fulfill its most basic promise? The countdown has already begun. Welcome to your OG John AG. Now, if you've made it this far, you're clearly someone who values real analysis over noise. Do me a favor, hit that subscribe button. Think of it like locking in your allocation before the shelf runs empty. And drop a comment. Tell me which city, which country you're watching from. Let's see how global this audience really is. Now, let's talk about what's actually happening. The COMEX exchange sits at the heart of the global silver market. Every day, traders, manufacturers, and investors rely on this institution to discover the true price of silver. It is not just a marketplace, it is the reference point that determines what silver costs everywhere else on the planet. But something unusual is happening inside the vaults. The numbers tell a story that most people are not paying attention to, and those who understand what these numbers mean are starting to ask uncomfortable questions. COMEX operates two categories of silver inventory. The first category is called registered silver. This is metal that sits in approved depositories, ready to be delivered against futures contracts. When someone buys a silver contract and demands physical delivery, this is the pool they draw from. The second category is called eligible silver. This metal is stored in the same vaults, but it is not available for delivery. It belongs to someone who has chosen to keep it there for safekeeping. Right now, registered silver inventory sits at approximately 100 million ounces. On the surface, 100 million ounces sounds like a substantial amount, but context changes everything. 10 years ago, registered silver at COMEX averaged between 150 and 200 million ounces. 20 years ago, the baseline was even higher. The current level represents a significant departure from historical norms. The metal that once sat ready for delivery has been steadily drawn down month after month, year after year. Meanwhile, open interest in silver futures contracts represents demand for over 400 million ounces. Open interest is not the same thing as guaranteed delivery demand. Most futures contracts settle in cash. Traders close their positions before expiration. They never intended to take physical delivery. They were hedging price risk or speculating on price movements. This is normal market behavior. But a percentage of contract holders do demand delivery, and that percentage has been rising. In a typical contract month, delivery requests might represent 5 to 10% of open interest. Recently, that pattern has shifted. More contracts are going to delivery. More participants are converting paper positions into physical metal. The numbers are not catastrophic yet, but the trend is clear. Here is where the mathematics become uncomfortable. If even 15% of current open interest demanded physical delivery, that would require 60 million ounces. The registered inventory could handle that, but it would consume more than half of what is available. If 20% demanded delivery, the system would face serious strain. If 25% or more insisted on physical settlement, the exchange would not have enough metal in the registered category to fulfill every claim. This creates a potential mismatch, and markets do not handle mismatches gracefully. The delivery process itself operates on specific mechanisms. When a futures contract approaches expiration, the holder has a choice. They can sell the contract and take cash, or they can stand for delivery and receive warehouse receipts for physical silver. Those receipts represent specific bars, stored in specific vaults, inspected and approved by COMEX standards. The system assumes that most people will choose cash. It has always worked that way. The exchange maintains enough registered inventory to cover expected delivery demand, plus a buffer. But the buffer is shrinking. What happens when assumptions stop holding true? February delivery requests came in higher than anticipated. March contracts are stacking up with more standing for delivery than usual. The pattern is accelerating, not stabilizing. Observers are watching vault activity with increased attention. Every week, the exchange publishes inventory reports. Analysts track how much silver moves in and out of registered status. They monitor which depositories are gaining metal and which are losing it. They calculate drawdown rates and project forward. The projections are what keeps certain people awake at night. At current delivery rates, registered inventory could fall below 70 million ounces by summer. If demand continues accelerating, it could drop to 50 million ounces or lower. At that point, the exchange would be operating with the thinnest buffer in modern history. This is not a prediction of immediate collapse. It is an observation of trajectory. The system is not broken yet, but it is moving toward a state where flexibility disappears, where there is no room for error. where one unusually large delivery month could trigger consequences that ripple through the entire commodity complex. The question is not whether COMEX will run completely out of silver tomorrow. The question is whether the current structure can sustain the stress that is building beneath the surface. And that question does not have a comfortable answer. Imagine a bank that promises customers they can withdraw their deposits anytime. The bank holds some cash in the vault, but most of the money is loaned out or invested elsewhere. This works perfectly fine, until the day too many customers show up at once asking for their money back. COMEX operates on a similar principle. The exchange does not exist to warehouse the world's silver supply. It exists to facilitate price discovery and allow participants to hedge risk. Physical delivery is supposed to be the exception, not the rule. The entire system is engineered around the assumption that most contracts will settle in cash, but assumptions have a shelf life. The delivery infrastructure at COMEX depends on a network of approved depositories scattered across the United States. These are secure warehouses operated by companies like Brinks, Delaware Depository, and JPMorgan Chase. Each facility meets strict security standards. Each undergoes regular audits. The silver stored inside these vaults represents the physical backing for the entire futures market. But here's the issue that few people consider. Moving physical silver is not like transferring numbers on a computer screen. These are 1,000-ounce bars. Each one weighs more than 60 pounds. They must be transported in armored vehicles. They must be inspected, verified, and logged into inventory systems. The process takes time. It takes coordination. It takes physical infrastructure that cannot scale instantly when demand surges. When a contract holder demands delivery, they receive a warehouse receipt. That receipt gives them ownership of specific bars in a specific vault. If they want those bars moved to a different location, the logistics become even more complex. Insurance must be arranged. Transport must be scheduled. The receiving facility must have space available. This is not a system designed for speed. It is designed for security and accuracy. Now, layer on another complexity. Not all silver in COMEX vaults belongs to the exchange. Much of it belongs to private owners who simply use COMEX facilities for storage. That silver sits in the eligible category. It is not available for delivery against futures contracts unless the owner decides to convert it to registered status. Why would an owner do that? Usually for a fee. If delivery demand is high and registered inventory is low, the economics shift. Owners can earn money by making their silver available, but this is a voluntary decision. There is no mechanism forcing eligible silver to become registered silver. The exchange cannot simply commandeer metal that belongs to someone else. This creates a structural bottleneck. When delivery pressure builds, the exchange depends on private owners voluntarily releasing their metal. If those owners decide to wait for higher prices, or if they simply prefer to keep their silver where it is, the registered inventory does not refill. History provides uncomfortable precedents. In March 2022, the London Metal Exchange faced a nickel crisis. Prices spiked to unprecedented levels. Some participants could not meet delivery obligations. The exchange made an extraordinary decision. It canceled trades. It suspended the market. Billions of dollars in positions were erased overnight. The credibility damage lasted for months. This was not a theoretical scenario. It happened on one of the world's most established commodity exchanges. In 2000 and 2001, NYMEX experienced severe tightness in palladium. Delivery demands exceeded available inventory. Premiums for physical metal soared far above futures prices. The market fractured. Participants who needed physical palladium could not obtain it through the exchange. They were forced to source it elsewhere, often at significantly higher costs. The pattern repeats across different commodities and different decades. When delivery infrastructure cannot absorb demand, the system adapts, but not smoothly. Regulatory authorities have tools available. The Commodity Futures Trading Commission can impose emergency position limits. They can restrict delivery demands. They can force cash settlements. These interventions prevent total system failure, but they come with consequences. They undermine confidence. They signal that the market cannot function on its own terms. And once confidence erodes, it becomes difficult to restore. Right now, early warning signals are appearing in the data. The spread between March and May silver contracts is narrowing in unusual ways. This suggests tightness in near-term delivery availability. Basis relationships between physical silver and futures prices are widening. This indicates that people are paying premiums to secure metal outside the exchange system. Options activity shows another clue. More participants are buying out-of-the-money call options. They are positioning for potential price spikes. They are hedging against scenarios where normal market relationships break down. These signals do not guarantee a crisis, but they indicate stress. And stress, when left unaddressed, has a tendency to compound. The infrastructure that supports COMEX silver delivery was built for a different era. It was designed when most contracts settled in cash, and delivery was truly the exception. That world is changing. The question is whether the infrastructure can change with it. A power grid operator in California makes decisions based on cost projections for solar panels. An electronics manufacturer in South Korea schedules production runs 6 months in advance. A hedge fund in London balances its commodity portfolio using futures contracts. None of these people think about COMEX vault inventory levels, but they should, because when a cornerstone market begins to fracture, the cracks spread in directions that nobody anticipated. Silver is not like other commodities. It is not just a precious metal that investors collect. It is an industrial necessity embedded in technologies that modern civilization depends on. Every solar panel requires silver paste for electrical conductivity. Every smartphone contains silver in its circuitry. Medical equipment, water purification systems, antibacterial coatings all rely on silver's unique properties. This dual nature creates an unusual problem. When gold faces supply constraints, investors adjust their portfolios. When copper tightens, construction projects adapt. But when silver markets destabilize, the impact ripples across both financial systems and industrial supply chains simultaneously. Consider what happens if COMEX can no longer provide reliable price discovery. Industrial companies use futures contracts to lock in their silver costs months ahead of production. A solar manufacturer negotiates panel prices with buyers based on futures market quotes. If those quotes no longer reflect actual physical availability, the entire planning process breaks down. The manufacturer cannot confidently commit to delivery schedules. Buyers cannot trust the pricing they receive. This is not theoretical uncertainty. This is operational paralysis. And it compounds quickly. Solar installations represent one of the fastest growing sources of silver demand. Industry projections show demand increasing by 15 to 20% annually. Every percentage point of that growth translates into millions of additional ounces needed. If procurement becomes unpredictable, project timelines extend, costs inflate. Investment decisions get delayed. The renewable energy transition depends on reliable access to industrial metals. Remove that reliability and the entire timeline shifts. Electronics manufacturing faces similar exposure. Modern vehicles contain increasingly complex electrical systems. Each system requires silver. Automotive suppliers operate on tight margins and precise delivery schedules. They cannot afford sudden price spikes or sourcing delays. If COMEX-based hedging becomes unreliable, manufacturers must either accept higher risk or pay premiums for guaranteed physical supply. Those premiums get passed forward. Vehicle prices increase. Consumer demand softens. Production schedules adjust. Employment levels shift. The chain reaction extends far beyond commodity markets, but the financial implications may prove even more significant. Major banks maintain trading desks dedicated to precious metals. These desks do not simply speculate. They provide hedging services to mining companies, manufacturers, and investors. They manage derivative positions worth billions of dollars. Those positions rest on the assumption that COMEX contracts represent legitimate claims on physical metal. If that assumption breaks, counterparty risk explodes. A mining company that sold forward production using COMEX contracts expects those contracts to settle reliably. If settlement becomes uncertain, the company's revenue projections become uncertain. Credit ratings reflect that uncertainty. Borrowing costs rise. Investment in new production declines. This creates a vicious cycle. Tight supply triggers delivery stress. Delivery stress undermines market confidence. Lost confidence reduces investment in new supply. Reduced investment guarantees tighter supply in the future. The cycle feeds itself. Other precious metals markets watch closely. Gold, platinum, and palladium trade on similar exchange mechanisms. If silver delivery fails, participants begin questioning whether other metals face hidden vulnerabilities. Capital migrates toward perceived safety. Liquidity fragments, price volatility increases across the entire complex. Volatility itself becomes a problem. When markets swing wildly, institutional investors reduce exposure. Pension funds and endowments have risk limits. Excessive volatility triggers automatic position reductions. This removes stabilizing capital from markets precisely when stability matters most. History shows how quickly confidence can evaporate. In 1980, silver prices spiked from $11 to $50 in months. The surge was not driven by fundamental shortage. It was driven by perception that shortage was possible. The Hunt brothers accumulated massive positions. Other participants panicked. The price explosion created chaos that took years to resolve. Today's situation differs in specifics, but shares underlying dynamics. When participants lose faith in delivery mechanisms, rational behavior becomes impossible to predict. Central banks monitor these developments quietly. Silver may not have the monetary status that gold carries, but it remains a strategic metal. Governments stockpile it. Military applications depend on it. Major supply disruptions carry national security implications. If COMEX fails to manage delivery stress smoothly, regulatory intervention becomes likely, but intervention itself creates uncertainty. Will authorities force cash settlements? Will they impose price controls? Will they restrict exports? Each possibility introduces new variables that markets cannot price efficiently. The business community faces difficult decisions. Waiting for clarity risks being unprepared. Acting prematurely risks overreacting to noise. The optimal strategy depends on probabilities that nobody can calculate with confidence. And that is precisely why this situation deserves serious attention. Not because collapse is certain, but because the range of possible outcomes has widened dramatically. When systems operate with narrow margins and high interconnection, small disruptions cascade unpredictably. A ship captain does not wait for the storm to hit before checking the emergency equipment. A surgeon does not wait for the patient to crash before preparing backup plans. Professionals in high-stakes environments understand a fundamental principle. Preparation is not pessimism, it is responsibility. The COMEX silver situation presents business leaders with exactly this type of challenge. The outcome remains uncertain. Complete collapse is not inevitable, but operating as though nothing could go wrong is no longer a defensible position. So what should rational actors actually do? The first step involves distinguishing between three distinct scenarios. Each requires different responses. Each carries different probability weights. The base case assumes managed resolution. In this scenario, COMEX navigates the inventory drawdown through a combination of mechanisms. Registered silver gets supplemented as eligible owners convert their holdings. Premiums rise enough to incentivize additional supply. Some contracts settle in cash rather than physical delivery. The exchange adjusts margin requirements to discourage excessive delivery demands. Price volatility increases, but the system continues functioning. The scenario aligns with historical patterns. Exchanges have faced stress before and adapted without complete failure. Regulatory authorities have tools available. Market participants have incentives to find solutions. Probability estimates for this outcome range from 50 to 60% based on precedent analysis. The stress case assumes partial breakdown. Delivery defaults occur but remain contained. COMEX implements emergency procedures, forced cash settlements for some contracts, temporary trading halts, position limit reductions. Physical silver becomes available, but at significant premiums above futures prices. Industrial users face procurement challenges. Hedging becomes less reliable. The market fragments between paper and physical pricing. This scenario has precedents in other commodity markets. It does not represent total system failure, but it does represent serious disruption. Business operations face complications, costs become unpredictable, planning horizons shorten, probability estimates for this outcome range from 25 to 35%. The crisis case assumes widespread delivery failure. COMEX cannot fulfill physical settlement obligations for multiple contract months. The exchange loses credibility as a price discovery mechanism. Alternative markets emerge. Regulatory intervention becomes heavy-handed. Supply chains experience significant disruption. Price discovery moves away from traditional futures exchanges. This scenario has limited historical precedent in modern developed markets. It represents tail risk rather than base case expectation. Probability estimates remain in the 10 to 15% range, but low probability does not mean zero probability. Each scenario demands specific preparation. For industrial companies dependent on silver supply, the strategic priority involves diversifying procurement channels. Relying exclusively on COMEX-linked pricing creates concentration risk. Establishing direct relationships with refiners and recyclers provides alternatives. Building slightly larger physical inventories creates operational buffer. These steps impose costs, but they reduce exposure to delivery disruption. The calculation is straightforward. What does 3 months of additional silver inventory cost versus what does a production shutdown cost? For most manufacturers, the insurance premium is worth paying. For companies using futures contracts for hedging, the focus shifts to counterparty selection and contract terms. Not all futures positions carry equal risk. Contracts with physically backed exchange-traded products provide different exposure than pure paper positions. Understanding these distinctions becomes critical. Some firms are exploring hybrid approaches. They maintain futures positions for price exposure while securing physical supply through separate channels. This costs more but provides redundancy. Investment portfolios face different considerations. Precious metals serve various functions: inflation hedge, portfolio diversification, crisis insurance. If COMEX delivery mechanisms become unreliable, investors must decide whether to reduce exposure or shift toward physically backed alternatives. Exchange-traded funds that hold actual metal and allocated storage provide one option. Direct ownership of coins or bars provides another. Each carries different costs, liquidity characteristics, and tax implications. The key question is not whether silver belongs in a portfolio. The key question is which form of silver exposure provides the intended benefits if exchange-based contracts become problematic. Mining companies face the most complex decisions. They produce the metal but also use futures markets to manage revenue risk. If those markets become unreliable, their financial planning becomes significantly more difficult. Some are considering longer-term supply agreements directly with industrial users. This reduces flexibility but increases certainty. Across all these considerations, one principle emerges clearly: monitoring matters. Waiting until a crisis erupts before responding guarantees suboptimal outcomes. Tracking specific indicators allows for graduated response. Those indicators include weekly registered inventory levels, delivery percentages by contract month, spread relationships between contract months, basis differentials between physical and futures prices, and options market positioning. When these indicators move beyond historical ranges, decision triggers activate. Firms increase physical inventory. They adjust hedge ratios. They secure alternative supply arrangements. They scale responses to the severity of signals. This is not about predicting the future with certainty. It is about maintaining operational flexibility across a range of possible futures. The business environment already contains enough uncertainty. Currency fluctuations, geopolitical tensions, technological disruption. Leaders manage multiple risks simultaneously. The COMEX silver situation represents one more variable requiring attention, but it is a variable that can be managed. Information is available, options exist, lead time remains sufficient for thoughtful preparation. The professionals who navigate this period most successfully will not be those who predicted the exact outcome. They will be those who remained adaptable regardless of which outcome materialized. Because in complex systems under stress, precision matters less than resilience. And resilience comes from preparation, not prediction. The countdown continues. The inventory drawdown has not reversed. The delivery demands have not subsided. March approaches, then April, then May. The question is no longer whether this situation deserves attention. The question is what each organization will do with the time that remains.